If you rarely sell your S&P exposure, liquidity risk may never affect you. If you rebalance during volatility or trade size, it will. Two ETFs can track the same index and still behave differently under stress. Because cost is not exposure, cost is execution. If you own SPY, VOO, IVV, or use futures for S&P exposure, this becomes a structural allocation question. Liquidity behaves differently when spreads widen and depth contracts. Most costs are visible in calm markets. Execution cost appears when liquidity tightens. That cost only becomes structural if you transact under stress. In this video, we'll map interaction frequency, order size relative to available depth, market stress regime, and instrument liquidity resilience. By the end, you'll know whether liquidity risk changes how you size capital or whether it remains dormant in your strategy. Most ETF comparisons focus on expense ratio. Expense ratio is continuous. It accrues daily, regardless of whether you transact. But total cost of ownership has two structural components: continuous cost, episodic cost. Continuous cost compounds gradually over time. Episodic cost concentrates during transactions. Continuous cost includes expense ratio, ongoing operational drag, tracking difference over extended periods. Episodic cost includes bid-ask spread, slippage, market impact, price concession under urgency. If you never transact during stress, episodic cost may remain small relative to decades of compounding. But if you transact precisely when liquidity contracts, episodic cost can dominate your realized outcome. A 4 basis point difference in expense ratio compounds predictably. A 60 to 80 basis point execution cost during a stress rebalance occurs instantly. Low expense ratio guarantees low continuous cost. It doesn't guarantee low total cost. Total cost is interaction dependent. Continuous cost is time dependent. Episodic cost is behavior dependent. Continuous cost increases with holding period. Episodic cost increases with transaction frequency and urgency. Investors often optimize the visible cost category, expense ratio, while underestimating the conditional one. If you trade quarterly, rebalance during drawdowns, or shift allocations tactically, episodic cost becomes cumulative. If you execute 2 transactions per decade, it likely does not. Another structural distinction: continuous cost is symmetrical, episodic cost is asymmetric. In calm markets, spreads are narrow and depth is stable. In volatile markets, spread widens and depth thins rapidly. Execution cost distribution is skewed towards stress regimes. If your behavior includes stress period interaction, you're exposed to higher cost environments. Cost hierarchy changes depending on your interaction pattern. Liquidity is structural depth, not average volume. Mechanically, liquidity includes order book depth across price levels, stability of the bid-ask spread, market maker participation, tradability of the underlying securities, derivatives ecosystem integration. Liquidity determines execution reliability under uncertainty. Deep liquidity means larger size can transact with limited price movement, quotes remain competitive, depth replenishes quickly. Shallow liquidity means small trades can move price, spreads widen quickly, size disappears under volatility. Liquidity contracts when volatility rises because market makers demand compensation for risk. The key variable is immediacy. If you require immediate execution, you accept prevailing liquidity conditions. If you can delay or stage execution, you may reduce cost. Liquidity interacts directly with urgency. Urgency increases execution cost. In stable markets, spreads are narrow, order books are layered, arbitrage channels function efficiently, market makers compete for order flow. In this environment, differences between major ETFs tracking the same index often appear negligible. For example, SPDR S&P 500 ETF Trust, SPY, and Vanguard S&P 500 ETF, VOO, both track the S&P 500. In calm markets, retail-sized trades typically clear efficiently in either product. At this stage, expense ratio differences appear more meaningful than liquidity structure. This is why liquidity risk often feels abstract. Most spreads appear tight. Most orders fill without noticeable slippage. If your interaction profile remains confined to stable regimes and moderate size, liquidity selection may not materially alter realized cost. Liquidity behaves differently when volatility rises. Mechanically, market makers widen spreads, displayed size decreases, depth becomes concentrated in the deepest instruments. Liquidity doesn't disappear uniformly, it concentrates. The most liquid products retain relative resilience. Secondary products experience greater spread expansion and thinner books. Execution cost increases non-linearly. A spread that averages 1 to 2 basis points in calm markets may widen to multiples of that during stress. Impact cost rises as available size declines. If you rebalance during volatility, selling equities to raise cash, rotating sectors, or reducing exposure, you're demanding liquidity when it's most expensive. In that moment, a small expense ratio advantage becomes less relevant than execution friction. If your strategy includes stress period interaction, liquidity depth becomes structural. If it doesn't, liquidity widening may remain unrealized. Liquidity depth is reinforced by ecosystem scale. Some ETFs anchor large institutional participation, active derivatives markets, systematic allocation flows, short-term hedging demand. Liquidity is not just order book size, it's network participation. For example, SPY supports one of the most active ETF option markets globally. Option activity forces continuous dealer hedging in the underlying ETF. That turnover reinforces two-sided liquidity and compresses spreads. Hedging activity generates continuous two-sided flow, improving inventory recycling and execution stability. Arbitrage activity constrains price deviations from underlying value, shortening dislocations and tightening spreads. The result is not simply higher volume, it's higher structural resilience. Other ETFs tracking the same index may lack comparable ecosystem participation. They may have lower options volume, fewer institutional hedging flows, or less arbitrage engagement. In stable markets, this difference may appear negligible. Under stress, it becomes visible. Execution reliability can diverge, even when exposure is identical. Liquidity resilience operates across layers: secondary trading, derivatives hedging, creation redemption, institutional rotation. When multiple layers are active, recovery after volatility is faster and spreads normalize more quickly. When fewer layers exist, recovery is slower and variance increases. Ecosystem depth provides shock absorption. If you rely on option overlays, tactical hedges, or rapid allocation shifts, instrument ecosystem becomes structurally relevant. If you rarely transact and don't use derivatives, ecosystem depth may not materially alter your realized outcome. Instrument selection should align with usage pattern, not headline similarity. Two funds can track the same index, but their execution infrastructure may not be the same. Execution cost scales relative to liquidity capacity. For small orders in deep ETFs, impact is typically minimal. As order size approaches a meaningful percentage of daily volume or displayed depth, slippage increases, partial fills increase, price impact accelerates. Impact is convex. Doubling order size does not double cost, it can increase it disproportionately. A trade representing 0.02% of daily volume behaves differently than one representing 1%. Serious retail investors allocating larger capital blocks must consider the scaling effect. Liquidity is capacity. Capacity constraints become more visible as portfolios grow or an exposure becomes concentrated. Two structural forces amplify size sensitivity. Position concentration. If a large portion of your portfolio sits in one instrument, allocation shifts become size sensitive relative to available depth, even in otherwise liquid ETFs. Synchronized flow. During volatility, synchronized rebalancing compresses one side of the book, amplifying impact even for moderate orders. Execution cost is not determined only by your order size. It's determined by your order size relative to available opposing liquidity at that moment. Displayed depth reflects current quotes, not guaranteed absorption capacity. Under stress, it can vanish quickly. This is why scaling into positions, staging trades across sessions, or using execution discipline can reduce episodic cost exposure. Deeper instruments absorb synchronized flows more efficiently. Shallower instruments transmit order imbalance into price movement more quickly. As portfolio size grows, liquidity selection shifts from convenience to execution risk control. If your capital remains modest relative to product depth, liquidity differences may remain secondary. If your capital becomes meaningful relative to liquidity depth, instrument selection directly influences realized cost. Liquidity cost depends not only on whether you transact, but how you transact. A market order demands immediate liquidity, and a limit order supplies conditional liquidity. In stable markets, the difference may be minimal. Under stress, the difference becomes material. Market orders cross the full spread immediately and may consume multiple price levels if depth is thin. Limit orders introduce price control, but reduce certainty of execution. In volatile conditions, partial fills increase, missed fills increase, repricing becomes frequent. This introduces a trade-off: certainty of execution versus certainty of price. Deep liquidity reduces this trade-off. Shallow liquidity amplifies it. If you require guaranteed execution, for example, raising liquidity or implementing a hedge, instrument depth lowers the cost of immediacy. If your timing is flexible, staged execution or limit discipline can reduce the episodic cost exposure. Order mechanics interact directly with liquidity structure. This is where many investors misunderstand ETF liquidity entirely. ETF liquidity operates on two layers: secondary market liquidity, exchange trading volume and order book depth, and primary market liquidity, the creation and redemption mechanism. Daily trading volume does not define total liquidity capacity. Authorized participants can create or redeem ETF shares using the underlying basket. This provides structural capacity beyond visible exchange volume. However, it doesn't eliminate execution cost. During stress, underlying securities may become less liquid, creation spreads widen, arbitrage bands expand. ETF spreads may widen even when trading volume increases. Secondary liquidity determines immediate execution cost. Primary liquidity determines structural scalability. For broad, large cap exposures, both layers are typically resilient. For narrower or thematic exposures, underlying liquidity constraints may amplify episodic cost. Execution reliability depends on ETF order book depth, underlying asset liquidity, arbitrage efficiency. Liquidity resilience is multi-layered. Its relevance remains conditional on interaction. If you trade frequently, rebalance during volatility, use options, or move meaningful size, choose liquidity depth. If you trade rarely and hold long term, choose cost efficiency. Same exposure, different execution outcomes. Liquidity only matters when you demand it. Match the instrument to your interaction pattern and the decision is finished. Continue with the next video, it builds directly on this.